Hi, welcome back to another episode of Wilken and Gutton Plans, the Balance Sheet Breakdown. On today's episode, we're going to be diving into digital assets. I'm Chris Frederick, a partner with the firm, and joining me today is who I consider to be our in-firm expert on all things, digital asset, digital currency. Karolis Matulis. So Karolis, thanks for coming back again.
Yeah, great to be here. Excited to talk about digital assets. I think that this is something that gets talked a lot about in the marketplace, and as accountants, we do get a lot of questions about it. So bringing some of this to light in a broader medium is definitely a great opportunity.
For sure. To me, I think the goal and approach today is to talk a bit about what digital assets are, how they're transacted, what maybe makes up them, and then we'll dive into a little bit about the super exciting accounting and tax aspects of it.
Yeah, well, we'll save the best for last.
Save the best for last. Accounting's for last. Yeah. So if you want to fast forward and get there right away, go for it. But it's coming. So, introduction to digital assets. Right. When I think of digital assets, the kind of two that come to my mind are NFTs and cryptocurrency. Is that about where they stop? Is there more to it than that? What's your thoughts, Karolis?
So it is a wide space. My thoughts on it are, digital assets is somewhat of a newly coined term. This is kind of the preferred verbiage of regulators and folks in Washington D.C. When they're writing regulations. There's still not a ton out there, but we have seen some proposed bills. Digital assets is the thing that they call it. It really encompasses a lot of what I think they define as cryptographically, backed currencies or kind of securities or whatever you want to call them. I think it's easier to kind of look at what some of them are, which is, Bitcoin was the founding father of all cryptocurrencies and all digital assets, and we've seen a lot of kind of progression in the marketplace to some more platform-driven cryptocurrencies such as Ethereum.
Yep.
Solana is a somewhat relatively, or it's a newer one. And on some of these platforms, we see development occurring in the form of smart contracts that generates tokens, which some of the tokens are the non-fungible tokens that you had mentioned, and some of them are tokens such as stablecoins that have a one-to-one pairing with the U.S. dollar for folks that don't want to be exposed to fluctuations in the pricing.
It wasn't that long ago where Bitcoin was looked at as a neat idea, right? Every time I think about the first Bitcoin transaction to buy those pizzas for, was it 80 Bitcoin or something?
Yeah, I think it was like 10,000 Bitcoin
it was,
like that. Yeah.
And it was a point when I had begun my investing life cycle, and I'm like, man, if only I bought $20 worth of Bitcoin, I could have gotten, I'd have more money now than I'd ever need.
Yep.
Right. And so it went from that to where we are now, which is, north of $20,000-$30,000 Bitcoin, to the U.S. dollar. It's certainly a changing landscape. COVID had exploded a lot of those NFTs. Some of those have really taken off in value. And so, can we maybe talk for a minute about tokens in general, right? Because when I think of tokens and NFTs, the first thing I think about are the digitally created images, the angry apes of the world.
Yep.
And that's just the tip of the iceberg when it comes to tokens.
Yeah. So tokens are they can really be anything and everything that you want them to be. The way to think about them is the cryptocurrencies such as Ethereum or Solana provide you a platform to write computer code, and through this computer code you can kind of create tokens through the functions that you write, and basically define what the rule set around that token is. So there's been, the most simple tokens are probably the NFTs and the images, and really what it says is it's an intellectual property kind of argument that this token represents ownership of the intellectual property of this image or of this art. So I think in theory, if you own one of these tokens, if you own one of these bored apes, you could put it on a shirt, and you could sell the shirt, and you can commercially kind of exploit the sales of that shirt.
Yep.
And you would be protected from an intellectual property standpoint that nobody else can take this image that you own, put it on a shirt, and basically commercialize the sale of those Bored Apes. So that's kind of I think the theory there. It's whether or not that's a great place to go is a different conversation, but that's kind of where it started as the most simple application of tokens. But we've seen a lot of development in the area. I think Blackstone very recently, in the last couple of months, has created a tokenized fund of U.S. Treasuries. So you can effectively buy tokens that represent ownership in this U.S. Treasury fund, and then the interest or whatever earnings of the fund are actually paid to you, the token holder, basically to the wallet that holds the token, gets the returns on that token. So a lot of that, has been kind of codified in computer code in the smart contract that, this is how the investment flows. And then obviously the token represents ownership in this kind of physical, or not physical,
it's
but
the underlying in those cases.
It's an underlying asset. It's not so dissimilar to what we used to see with the gold funds, the spider gold funds, that sort of thing. And I think that is really where things are going to go from a token perspective, is tokenizing real world assets that people want to own, and kind of expediting the transaction flow,
right?
And being able to kind of transfer and sell those tokens directly from one person to another without an intermediary. That's really, I think, where the value is going to be. It can also manifest itself in the supply chain. You can tokenize items such as inventory. If in a warehouse, you can have a QR code that represents a token address on the chain. You scan it on the site, you ship it to your customer, they scan this piece of inventory on site, and the smart contract would basically say, your customer has received the inventory that you sold to them, and you can actually program in business logic that, hey, now I get paid, and that could kind of occur automatically. So a lot of that stuff is in development, and I think you'll kind of have varied success depending on the size of the business you're in. I think a lot of the Fortune 500s are already dabbling in this sort of application. It's just a question of how quickly is it going to transpire down the chain to Main Street,
right?
That you and I kind of work with for the most part.
Right, and that's maybe an example I hadn't given much, I hadn't even considered. Right, is tokenizing a piece of inventory, assigning a digital token to a physical item, and having a better track through the ledger. Right, that was always the big thing with the ledgers in general. It's about, hey, completeness and accuracy in the overall reporting, being able to see all sides of the ledger. And so now taking it to the next level and mirroring that with physical goods. Certainly is a big step in the next direction. Yeah.
So the one point that I'll make, because I already hear somebody in the crowd shouting this out, like, well, how is this different from kind of tracking it through your ERP? Well, the difference is that you have an ERP system and your client has an ERP system, and these systems are on different platforms. Through blockchain, what you're able to do is you're able to kind of operate on one system. So then, this piece of inventory transitioning from yourself to your client is visible to you and your client. And there are privacy kind of tools within some of the chains that allow this to be obfuscated from other participants in the blockchain. The general flow would be, you make an entry in your ERP system, the client receives the piece of inventory, they make a entry in their ERP system, they update their accounts payable. You have an accounts receivable, at some point they pay you. That satisfies their AP. And when you see the deposit, that you match it up, that satisfies your AR. But you can actually just program in all this business logic between the two parties on a kind of equal playing field. Or a playing field that's accessible to both, and kind of increase the speed of recording and transactions between the two parties. and for accountants, for auditors, you don't have to review all the transactions. Then you just have to review the controls around, is this being scanned?
Right. The booking of the transaction.
Yeah, is the business logic that's programmed into the smart contract, is that valid? Are there any holes in it?
Yep.
That sort of thing. But I think from an audit perspective and from an accounting perspective, there's a lot of promise that this is going to revolutionize the way that we do things.
Yeah, I mean, gone would be the days of AP and AR confirms, right? Because you track it through and say, hey, I see it. We can see it on both sides of the ledger. If I've got the AR, they've got the inventory.
Yep.
Great.
Yeah, you see the flow of the physical goods and you see the flow of the funds.
Yeah.
So it is definitely something that is revolutionary.
And so obviously with advances in technologies comes with it are changes in security concerns, right? To me it sounds, oh hey, my inventory is up in the blockchain and it's my system's connected to your system. Hey, the underlying S&P assets are tokenized. What's your thoughts on maybe the evolving security landscape? What does that look like? Is there more risk involved than maybe doing these things through traditional means?
So there's definitely a lot more what we'll call kind of development concerns.
Yep.
You have to make sure that the smart contracts are doing what they're supposed to be doing. I think we're at a place where, from a platform standpoint, most folks are pretty comfortable. So most folks are comfortable developing on Ethereum, Solana. There's folks that are comfortable developing on Solana. Which one folks choose, and actually there's a bit more beyond those two, but those two are the heavy hitters in the space currently. There are things to worry about that go beyond, the platform, and that's going to be the smart contracts.
Yep.
So in digital assets, we have, or this new category of risk that I refer to as smart contract risk. So a lot of times there's platform risk, and I think most folks are pretty comfortable with the platform risk. Like the Ethereum chain has been operating without a hitch for the last, I don't know, I think it came out maybe in 2011, 2012,
Mm-hmm.
and it works like clockwork. The blocks come every 12 seconds, and the transactions haven't been reversed to my knowledge in that period of time. But I will say that there has been many instances of smart contracts being exploited for one reason or another, and funds being stolen. And that's really kind of, I think, the class of risk that is most applicable. But that's unique to the space of tokens. You can transact on things like Ethereum without assuming contract risk, and the only thing that you're really assuming is the platform risk. So as long as you understand the risks, and as long as you have a team that's supporting you in terms of developing the smart contracts that help your business, I don't see this as a highly risky area. But I will acknowledge that for a lot of folks that aren't in the space and aren't familiar, there's obviously a lot of kind of anxiety about all the things that you don't know, and naturally folks will gravitate to being scared of the things that they don't know or don't understand yet.
For sure. And so one final question before we switch to maybe some of the more accounting specific items. Why do these things have value, right? Like why does Bitcoin have value? Why does Ethereum have value?
To transact and deploy contracts on the Ethereum chain, you need to own Ethereum. Ethereum is effectively the oil of Ethereum, and they call it gas. So for you to deploy a smart contract on the Ethereum chain, you basically need to buy some Ethereum, and you use that to fund the transaction, to pay the network fee for the transaction. So there's a natural kind of demand functionality built in. The more people that are using the platform, the more buying pressure there is on Ethereum to pay for all the transactions on the network. They've gotten it to a point where the supply of Ethereum is, I think for all intents and purposes, you can say is somewhat fixed. So it's not necessarily inflationary.
Yep.
It is slightly deflationary depending on the period of time. In periods of higher network usage, it becomes more deflationary. In periods of declined network usage, it becomes slightly inflationary. On balance, over the last year or two, it's been deflationary. So that's kind of the thing that you need to buy it to use it, and anytime you use it, a portion of it is burned up in the transaction. So there's a kind of a natural equilibrium where there's a buying pressure. Obviously, there's and part of the security model within Ethereum is there is buying pressure coming from the fact that to secure the network, you need to own X amount of Ethereum. The number is now 32.
Okay.
So for you to participate as a trusted node / validator within the network, you need to own 32, and you need to put that up as collateral.
Okay.
So as transactions come through, as you're reviewing those transactions, and you're not physically doing this, like computers are doing it, if you don't kind of follow the rules of the platform, your deposit of 32 gets slashed, and you basically lose it. So that's kind of the incentive model that keeps all the actors within the network acting in the way that the platform is designed to do. So that there's buying pressure there. Now, Bitcoin, I think, as we said, is the founding father of cryptocurrencies. And the way that Bitcoin, I think, gets his buying pressure is from this perception that it is an inflation hedge for folks that maybe don't feel that the U.S. dollar is done going through an inflationary phase. To preserve buying power, they purchase something like Bitcoin because Bitcoin is set to have only 21 million units. There's not going to be any more. The current inflation rate, I think, is in the very low digits. So part of the perception is, as the U.S. dollar goes through these inflationary periods, and depending on how folks feel about the national debt and the prospect of actually paying that off with hard money or soft money. And when I talk about soft money is, we're just going to print a bit more money and we'll cover the debt, and that's how we're going to that's how we're going to get out of it. So there's a lot of folks that are also in that camp that view Bitcoin as a way to hedge the idea that the U.S. dollar will continue to inflate, and the way that we're going to get out of those debts will be through kind of continual inflation. So it's seen as a way to preserve buying power. Now, is the level of pricing of Bitcoin the right one? I'm not sure, and I'll say, but whatever Chris and I are talking about here, this is not investment advice.
Right.
We're just two guys talking about digital assets.
Right.
And an accounting firm.
Not to be confused.
Yeah. So do your own research. Obviously, Bitcoin has had an ETF released in the recent months. I think that's resulted in a lot of additional inflows. Now that it's a lot more accessible, you don't have to open a Coinbase account. You don't have to kind of go through the self-custody route. You can just log on to your brokerage house. And you can purchase one of, I think there's 10 Bitcoin ETFs. And a lot of them are 0% fees for the first year or two. So it's a pretty low risk way to invest in Bitcoin. And I will say the major upside of the ETFs is it makes owning Bitcoin in tax advantage accounts very, very easy.
Right. In your IRA, and you can just go ahead and buy the ETF like you would the S&P ETF. And you're off to the races.
Because before it was pretty difficult to set up a structure where you could own Bitcoin in a tax advantaged account. So that was a big challenge, and I think there's kind of growing comfort level from the investing community or the investment advisor community to say, hey, I don't know about this Bitcoin thing, but maybe it's got a place of 1-2% of your overall portfolio.
It's been around for long enough.
There
seems to be wider and wider adoption of it. People are able to execute some daily point of purchase transactions. It's maybe not going away like that first person who bought the pizzas for 400 Bitcoin thought it might.
The argument is kind of similar to what we see, I think, around gold. Nobody is buying pizzas with a slab of gold.
Right.
But everybody feels that owning gold in their in their investment portfolio, at least a couple percentage points,
Yeah.
is not a bad route to go. So I think a lot of the same arguments can be made for assets like Bitcoin.
Right, and to your point, the gold was always the safe spot in uncertain waters and in inflationary periods, and so it makes similar sense of what the connection here is.
And we have seen some governments kind of adopt Bitcoin as their de facto reserve currency in the recent year or two. Whether or not that's a great decision, I guess, is yet to be seen. But
right.
Some of these economies have been struggling for a long time.
Right, with
so
hyperinflation and the like, and so
Yeah, so it's a half-court shot that might go in.
Yep. And so that's maybe a good transition into some of the accounting topics. And so to me, the kind of first thing that comes to mind is valuation, right? And so there's a lot they're easy to think about valuation-wise, right? There's a lot of these things that are publicly available. They're listed. They're traded every second of every day, and it's information available in the U.S. dollar. But that's not the case for everything, right? Like we talk about some of these tokens and things, and so valuation can really be a bit of a tricky subject. It's worth whatever you're willing to pay for it.
Exactly, and some of them are pretty thinly traded. I think for the most part, the significant currencies, the major currencies that folks that are not in the space, you'll be able to get a quote on any minute and second of the day, as you had mentioned, just based on the fact that they are traded on major exchanges. Some of the less traded coins let's say they have a Bitcoin pairing or they have an Ethereum pairing, and you can basically ascertain the value of it based on, it's Ethereum, and Ethereum is trading at 3,000 on date X, and you use 2 Ethereum to buy this NFT on the same date. So, the value of this asset from a tax standpoint or from a cost basis standpoint is the 3,000 Ethereum times the number of units that you gave up to buy the NFT. And that's what's going to be used for tax purposes. I will say that there's been an interesting kind of communication from the IRS in terms of using charitable deductions and cryptocurrency. So let's say you have some cryptocurrency and you give it to a charity. In terms of what the value of that charitable deduction is, you actually have to go and get an appraisal for that charitable contribution. I think the theory is that in the eyes of the Internal Revenue Code, or at least in the way that the IRS has kind of communicated that they're going to be interpreting this, is that the digital assets are considered to be property, so they will apply all the property rules to the treatment of digital assets, and that includes the way that you report charitable contributions of property. So if you give a car away, you have to effectively get an appraisal.
You get an appraisal, and that's and that becomes your
charitable deduction.
Contribution.
So it's not entirely foreign, but a lot of folks, kind of from a functional standpoint, don't think about cryptocurrency and digital assets as property. They don't think about it as a car. They think about it as, well, this is a currency.
It's currency,
and it's denominated in dollar terms, and I can figure out what the dollar terms are. But in a lot of ways, the Internal Revenue Code doesn't really see it that way.
It doesn't give you the break. Thinking about tax implications, I buy Bitcoin for X, I sell it for Y, and I've got a gain. Will I be getting a 1099 from the exchange? If I don't, what's my obligation to pay tax? What does that look like?
Yeah, so in this scenario that you had pointed out, you buy Bitcoin for X, you sell it for Y. That's a pretty simple transaction. You have a gain on the difference. You have a holding period depending on when you bought and when you sold. That's pretty clear cut. You can do that with the calculator pretty quickly. Where it gets tricky is if you bought Bitcoin and then you use Bitcoin to trade into Solana, and then you used your Solana to buy an NFT on Solana, and then you sold your NFT and you traded the NFT back into Solana, and then you took your Solana and you traded it for Ethereum. That's where it gets really.
That sounds like 7 transactions.
Yeah, that's 7 transactions, and what you're supposed to be doing is you're supposed to be checking the dollar value of each of the currencies that you're kind of exchanging. You're deemed to dispose of the currency for dollars, and then use those dollars to buy the next currency.
Interesting.
So you effectively have kind of a taxable transaction in each and every step.
Yeah.
And most folks don't really think about it that way. They think about it as, well, I bought Solana,
Right.
X amount of Solana for X amount of dollars, and then, I played around with the
Right, it's
NFTs
just
in
in
there,
there.
and then I took out X amount of Solana, which is now less,
Yep.
so therefore I don't owe any tax.
Yeah.
And that's really the wrong mindset to have, or that's not the way that the IRS thinks about it. And you could have a pretty significant tax bill, and you can also have kind of a very challenging exercise in terms of ascertaining cost basis, because you really have to go back to the very, very beginning in terms of when you bought this Bitcoin, which could have been in 2013, but then you used to trade up into all these other different things, and you had taxable transactions along the way. So you have to trace the basis all the way through, and that's where it becomes very challenging. On the 1099 question, you will not get a 1099 for 2023. I think some of the exchanges will start issuing a 1099 DA starting in 2024. This is a brand new form. They have issued it in draft format. This is a whole podcast episode on
Right.
on the form itself, but the way that the form is designed is it will effectively issue a 1099 DA for every single transaction
Oh, interesting.
that you have.
So you'll get a stack of them.
You'll get a stack of them, and what's kind of funny about it is the number of 1099 DAs that I think the IRS should expect are probably 3, 4, 5x the amount of 1099s and informational reports that they get in a year. Period.
Right.
So it's very unlikely that they're even remotely prepared to receive the deluge of informational reporting. And there's still a lot of conversation who's like subject to be a 1099 DA issuer, who's not. Because a lot of these transactions kind of happen at the platform level in smart contracts. So the question is, well, who's supposed to issue the 1099? We don't actually have a human being or a corporation or anybody responsible for these transactions.
Right. There's nobody to hold.
Yeah, we're connecting to the smart contract is connecting to
It's
folks that want to exchange.
Facilitating. That's all it's doing. It's not.
So I mean, if you're on Coinbase, do expect a 1099 DA at some point in the future. Cost basis is going to be an issue, but it's always messy. This kind of intermediary time between we had the
Wild West.
Yeah, we had no guidance, and now we have guidance, and then bridging the gap between two is going to be very challenging.
And to your point, the current guidance seems like a lot. Getting a 1099 DA for every transaction by the minute, right? It's
multiple transactions by the minute.
So,
yeah, and
those are the ones who you do not want as a tax client, who show up with 1,000 1099 DAs and say, "Oh, Karolis, I don't know, man."
The tax preparers don't want them. The IRS does not want them.
Exactly.
And the clients don't want them.
Nobody's going to be looking at these things. It's just,
nobody wants these 1099 DA forms. But
yeah.
I do think that something is necessary, just from the standpoint of a lot of folks kind of have this mindset of, if I didn't get a form,
it didn't happen.
It didn't happen. This is not taxable income. I don't need to report it. And that's not the right attitude to have.
Right, and I'm sure there are plenty of people out there who are happy to not pay tax on their expected gains of cryptocurrency transactions, and so this is kind of where the regulatory compliance starts to ramp up, and
the IRS calls this Operation Hidden Treasure.
I'm sure they do. I wouldn't expect there to be a lot of people harboring losses out there that are not taking losses where they can. I'm sure with what the market has been for cryptocurrencies over the past 3 or 4 or 5 years, it's all unreported gain, right?
Yeah, it's actually possible to have, and that's why I encourage people to go through the exercise of figuring out, because it's very possible that you might actually have losses. So when we went through kind of the last crypto winter between, 2022, 2023, where the market was down, to the extent that you bought an NFT for, let's say, 10 Ethereum in 2021 at the height of the market,
Yep.
where Ethereum was 4,000, and then let's say you sold the same NFT for 10 Ethereum in 2022 or 2023 when we were at the bottom of the market, and in nominal terms, in Ethereum terms, you didn't gain or lose any money.
Yep.
But from a standpoint of how the IRS is actually doing the calculation, you might actually have a significant capital loss where, you didn't really have it in nominal terms.
Right, because it's like you said earlier, it's all based on every transaction valued at USD, not the more nominal terms of the underlying currency.
Yeah, so you might actually have losses. So folks kind of are under the impression that this is all gains, but
yeah,
in actuality, you might have some losses that you're not taking advantage of. Or the worst part of it could be you didn't take advantage of the losses or create capital losses in 2021, 2022 when you could, and now those returns are no longer
right. They're locked.
You can no longer amend them, and you don't have those carry forwards. And now in 2022, 2023, you might have gains, and you can't say, wait a minute,
right,
I have losses from that year. Well,
right.
it's
right. My basis isn't as low as you think it is. Well,
yep,
you missed that boat.
So that's definitely something to kind of be on the lookout for.
That's really interesting. And that's back to the comment you made earlier about risk management, right? That there really is a lot of volatility. We're not investment advisors, right? That there is still a bit of volatility in this marketplace and still moving.
Yeah, I think there's a lot of asset classes that have some volatility, but blockchain and cryptocurrencies are certainly probably some of the biggest leaders in the volatility space.
Yep.
I do think that kind of expansion of the Bitcoin ETF, there's going to be an Ethereum ETF at some point. I think that's going to bring some stabilities to the market, or kind of increased stability. It's
more mainstream. There's always more. There's now more buyers than ever in the marketplace.
Yeah, and there's more dollars are needed to move the needle on pricing in either direction. The volatility is certainly going to be there on some of the smaller traded currencies, especially on the NFTs, where whatever the value of it is just a question of what is somebody willing to pay for it.
Right.
I know that you're a fan of baseball cards, right?
Yep.
So what is the value of the baseball cards, and what's the volatility of baseball cards?
Right. I'm not buying Bored Apes for my long-term investment, and I'm not buying baseball cards either. It's big risk and big unknown of each.
Yep, but sometimes it's not about an investment that's knock it out of the park. Some people just like the way the cards look.
My son and I rip packs more often than I maybe care to admit, and that's what it is, right? It's rip them, shove them in a box. If they're worth something, they're worth something. And I can certainly see the connection you're making to NFTs. It's the same thing. Hey, that's an image I'd like to own. I'd like to be one of the 1,000 people that have that one. Yep, let's go for it.
Yeah, it's a bonding opportunity.
Yep.
And if the card is worth something 10, 20, 30, 40, 50 years down the road, great. If it's not, I'm happy.
Yeah.
I'm happy to have it.
So the NBA actually has their own NFTs. They've married together the idea of ripping baseball cards and the idea of buying NFTs. What you do is, and obviously, my son and I, why not? Got to pick a handful up. You actually get a pack of like 5 unknown images or small video clips, and then I own one of the 10 of the LeBron James dunk against whatever, right? And so it's the same idea, right? Like, it looks great. I have a digital wallet on this NBA site. Listen, it's just something I enjoy.
Yeah.
And that's that's certainly a big piece of it with a lot of these NFTs out there.
Yeah, and I think the upside is it makes it to the extent that you do want to monetize it.
Yep. Yeah.
And maybe you don't want to keep a physical box of stuff. Maybe we're becoming increasingly comfortable owning digital copies of the things we own.
Yep.
I don't know how many photo albums you have in physical form now.
Not from the last 27 years, right?
Yeah, people are comfortable kind of having it. It's like, hey,
Yeah.
Google, hey, Apple, you got my photos.
Yep.
I know
trust
where
you.
I can.
Yeah.
I know where I can find them. I know who to call.
Yep. Yeah. No, you're right. And to your point, selling the digital baseball cards, I can do it instantaneously. There's offers that exist out there where if the physical ones sit in a closet.
Yeah,
And
you got to go to Englishtown. You got to
exactly. Or sit on eBay and take my 50 cents a piece and deal with shipping. It's it's different, right? And to me that's maybe a good way to kind of wrap it up, right? Is it's still evolving, it's still growing, but hey, it's becoming more and more mainstream. But there are some tax compliance obligations that kind of come along with it.
Yeah, definitely. I hope that the tax compliance and the regulatory framework doesn't become overly burdensome for the space.
Yep.
And I'm thankful for the fact that it has taken a somewhat significant amount of time to kind of start formulating ideas on what the regulations should look like, because it did allow the space to flourish, for the platforms to develop, and for us to start getting some ideas on where is this going, how it's going to get there, without thinking too hard about what is the regulatory framework.
Yeah.
There's certainly a ton of kind of question marks that exist from the SEC side that are continuously being worked on, but we do have some bills within Congress that will hopefully bring some more clarity to the space where clarity is needed.
Yep.
And that's in development. Obviously, I don't know that we're going to see anything this year, but after the election, we might see some more activity. It certainly has a bit of attention, and I think it's becoming a somewhat of a presidential election topic in terms of which candidates and which parties are in support of innovation in the space, and which are more burdensome for the space.
Yeah, no, for sure. And Karolis, obviously appreciate your insight on this. This is at least to me a bit of an unknown. So it seems like every time we talk, there's always a new development, a new thing that's happening.
Yep.
So
Absolutely.
it's helpful.
Yeah, great to be here. If anybody wants to chat about digital assets, feel free to drop me a line. I'm always happy to talk about it.
Yeah, for sure. And so I think with that brings us to the end of another episode of Wilken and Gutton Plans the Balance Sheet Breakdown. I'm Chris Frederick, where we help you make sense of the numbers.